2022, retirement accounts ran into a brick wall. 4 in 10 investors lost years of progress on their investments, and it wasn't all at once either. Over the course of 12 months, the S&P experienced a 20% drop, and every time investors thought maybe the bleeding would stop, it picked up again. That 4 in 10 figure includes all ages, but it gets worse for the younger investors. When you drill down into the details, 70% of Gen Z investors and 57% of millennials panic sold their investments. For many investors, this was their first bear market. And even for seasoned investors who've been around the block, 22 was the worst since 08. And 08 may have been a distant memory, but headlines across the board highlighted how awful things were and compared 22 to 08. To make matters worse, if these investors don't learn from their mistakes, they'll add roughly 10 years to the amount of time they'll have to work. Hey folks, I'm Daniel and I'm going to cover everything from the psychology of the market, typical post-recession performance, dollar cost averaging, how the S&P 500 is doing now, what stocks are leading the charge, and how to plan for the next recession. Coming up next. In his 1986 letter to Berkshire Hathaway shareholders, Warren Buffett famously stated that what we do know, however, is that occasional outbreaks of those two super contagious diseases, fear and greed, will forever occur in the investment community. The timing of these epidemics will be unpredictable, and the market aberrations produced by them will be equally unpredictable, both as to duration and degree. Therefore, we never try to anticipate the arrival or departure of either disease. Our goal is more modest. We simply attempt to be fearful when others are greedy and be greedy only when others are fearful. This is so powerful because even Buffett doesn't pretend to know what will happen. He simply acknowledges that he doesn't know, and he presents a healthy framework for how to approach the unpredictable nature of the market. In a world where financial analysis is at our fingertips, everyone is an expert and has an opinion. Here Warren is saying, I don't know when or how long this bull or bear market will last, and I don't know how good or how bad it will be, but here's how I'm going to handle it. I'm going to be a contrarian. It's also striking that he describes fear and greed as an epidemic. We all remember how the COVID pandemic turned this country upside down and how many of us are still feeling the effects of such a controversial and upsetting time. For our country, he describes fear and greed in a similar manner, as though it takes on a life of its own, like a virus, and it's not easily stopped. You know what else stops the virus of fear and greed? Subscribing to my channel and hitting the like button, guaranteed to work 60% of the time, every time. So what does a pandemic of fear look like? I already showed you a couple of headlines, but let's take a look at this heat map of the market at the end of 22. Notice all of the red. It's dominant. You have some green in there, but red dominates the majority of the map. The 10% losses are in dark red, the 20% losses are in the medium, and the 30% are in bright red. Unfortunately, the big dogs like Apple, Nvidia, Microsoft, Google, Meta, Amazon, and Tesla were all down over 30% in that bright red. It was absolutely a bear market. Fear was dominant, and many new investors in the millennial and Gen Z cohort did not handle it well. Take a look at this chart from Zero Hedge. It breaks down the losses of 22. I've blocked off the left labels in blue because I don't want you to get distracted. For now, let's focus on the losses. The vast majority of the markets are showing losses. We have a huge cluster here with losses in the 15 to 25% range, and then you have AI, tech, and mega cap stocks out in the 45% to almost 65% range of losses. The NASDAQ gets absolutely hammered in 22. So again, let's go back to that 22 heat map where fear was rampant, and then take a look at the most recent 23 heat map. It's basically an inversion of 22. 23 has been a year of greed. We reached levels of euphoria again, and the epidemic of greed has taken over. So let's go back to that original chart. I'm going to remove this blue box to the left, and let's pay attention to the left side. This is the performance of these stocks in 23. The stocks that were the furthest to the left are also some of the ones that are the highest, which means they had some of the most remarkable recoveries. Remember this cluster of stocks? Many of them are in that same 15 to 25% range, but instead of losses, they're now gains. It's been a remarkable turnaround. Something to keep in mind though is that the 23 heat map dominated in green is not all good news. It's just a few companies leading the charge large in performance. Investors are optimistic about the Magnificent Seven that I mentioned earlier. They include Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla. These companies are responsible for the majority of the growth this year. Here you can see that a whopping 71% of stocks have underperformed the S&P 500 this year. This is the highest percentage of stocks in the past 23 years, and it's not even close. On this next chart, we can see that within the S&P 500, 493 of those companies are doing great, exceeding the average 10% returns that the S&P 500 is known for. Once you factor in the Magnificent Seven, the total returns of the S&P are bumped up. If you separate those 7 though, there's 63% gap between those 7 and the 493. As those Magnificent 7 go, so goes the S&P 500 and the NASDAQ. It doesn't mean those 493 aren't doing well, but it's just a matter of waiting. If fear and greed are a fact of life with investing, how often can we expect the fear? The answer is quite often. Approximately every 6.5 years. Here's a chart of recessions. Every vertical gray bar is a recession. They vary in length of time and severity, but they're an absolute certainty. The average recession lasts 17 months with the annualized cumulative return of minus 15%. I don't want to gloss over that. Your average recession is nearly a year and a half. That's a short period of time to watch your portfolio suffer, especially without the ability to see into the future. It's a bit better post-World War II, with the average recession lasting just 11 months. So if we can expect a recession to occur on average every 6.5 years, for them to last approximately 1 to 1.5 years, and for the market to drop on average of 15%, what happens next? How does the market respond? Here's a great visualization that shows the S&P performance 1 year after recessions in a post-World War market. Out of 11 recessions, 10 resulted in positive outcomes, with the only outlier being 2001. My theory for this is that the dot-com bubble was a period of obscene greed. We had 5 years straight of 20 to 35% returns. That just cannot last. Then 9/11 occurred. It was the convergence of world-changing events and a market correction. The 1 year period after these recessions formally ended produced positive S&P 500 returns with an average gain of 15.5%. The main takeaway here is that we should be optimistic when fear is taking over the market. That's when you get great deals. You never want to pay a premium on anything. Buying at a discount should make you excited. Although many are thrilled with how 23 has turned out, I would caution you that 23 was a return to the mean. The numbers changed, but the response is not abnormal. At the time that this screenshot was taken, the S&P is up 23%. Fear is gone and greed abounds. I started this video talking about young investors struggling to handle the market. If you're a younger investor, please heed this warning. If you sell off every time the market hits a rough patch, you'll be selling off an average of every 6 to 8 years. Every time you do this, you're setting yourself back a couple of years. If you do this every time over the course of your working and investing career, you may sell off 5 to 6 or more times, potentially losing a couple years of growth and buying at a discount. Put another way, you could be wiping out a decade of investing growth by doing this. The solution to this is simple. Dave Ramsey has a great saying about how to handle the ups and downs of the market. The only people who get hurt on a roller coaster are ones who jump off. This is a great illustration, and I think it succinctly explains how to avoid financial injury. So what is the solution? Unless you have a lump sum amount, you should dollar cost average your investments. All this means is you automatically invest at regular intervals no matter the performance, and you refuse to attempt to time anything. Think long term. Commit to staying in the market for the next 20, 30, or 40 years. I have, and I will continue to do so. I automate my investing. My 401k is automatically invested every paycheck. My Roth IRA is automatic every 2 weeks. Automating your savings and investing should be done on day one. Set it and forget it. If you don't, that money will burn a hole in your pocket and you'll start looking for ways to spend it. You'll adjust your monthly budget and your spending habits. Force discipline on your financial life, and your future self will thank you. Remember earlier I talked about buying at a discount and how we should celebrate it? I didn't say that we should spend time researching the right time in search of the best discount. Don't hold your money in your settlement account and then lump sum invest when you feel the time is right. You'll rarely get the timing right, and your stress levels will be high. I'm speaking more to the mental framework through which you should view your investing. When the market is up, invest. When the market is down, invest. When the market is down and you get discouraged, remind yourself that you're buying at a discount. This will keep you focused on the prize. If we look at the S&P, this line is the average of our investments. If we bought above the line, we overpaid. We paid a premium, and that's okay, we're still in the game. If we bought below the line, congratulations, you get a great deal, and that's where you offset any premium you might have paid. This is what dollar cost averaging looks like, and it's the best way for the average investor to build wealth over time. And if you're interested in learning about the power of dollar cost averaging versus timing the market, check out my video here.